All right, for more on today's market action and the effect that the European debt situation is having on world markets, we're joined by Charles DeVoe. Charles manages $1.5 billion through the IVA International Fund. It's outperformed 84% of its peers year to date. Charles, good to have you with us on Bloomberg.
Thank you, Pimm.
All right, so give me the perspective of the investor when they're looking at what's happening in Europe. 85 billion, what are we talking about, dollars set aside for Ireland. Who's next?
Well, who's next? Possibly other countries, Spain, Portugal, come to mind. But bear in mind that the problems Europe has goes beyond too much debt in certain countries. It's also the fact that some countries, Spain, Portugal, Greece, Ireland, are just not competitive with the exchange rate of $1.30 to the euro. Now, Germany is very competitive. Germany has a big trade surplus, but those areas are not competitive. And I believe that it's not unthinkable in the long run for the Eurozone to be split in two.
Two groups in the Eurozone.
Yes.
So what do you have? Like Euro 1 and Euro 2?
Yeah, maybe the D-mark zone with Germany, Netherlands, France, Austria, Belgium, and then maybe the Eurozone comprised of the countries from the Southern Belt.
Is there a situation that exists in Europe where basically the social network that exists is just too expensive to maintain because you also have a demographic shift that has been gradually occurring where you're not going to have enough workers paying into a system in order to support the people that want to retire?
Yes. One of the other negatives Europe has, in contrast to America, is that their demography is not as vibrant as ours, and that's another headwind against them. Now, not everything is bleak in Europe. Again, there was no residential lending boom in Germany. People save a lot more in Europe, but there have been some excesses that will be very costly to cure.
Does this mean that there are some values to be had in Europe by people just sort of taking a general look and not looking at the details of the companies?
Yes, Pimm. As you know, with the markets, typically people will throw the baby with the bathwater. And I think people should not confuse Europe and its problems with European companies. There are many European companies listed in Europe, Nestlé, Sodexo in France, many others, who that have only a little part of their revenues, their business is generated from Europe. A lot of those companies are multinational, and so despite the problems in some of the countries, some of those stocks that are very global in scope do offer great value.
Charles, before we talk about some specific companies, what kinds of concerns are you hearing from your investor base, from the clientele? Are they worried about volatility?
Yes. Investors have lost so much money over the past 10 years, whether it's on their home, the tech stocks they used to own in the late 90s, and in 08, many lost quite a bit. And so people, rich or less rich, what they care first and foremost is not to lose money. So a fund that can minimize drawdowns will typically appeal tremendously to them.
All right, so let's talk about some of the companies that help you do that, help you minimize some of these drawdowns. I know you've been focused on Japan, of all places. Are we talking about a 14% allocation, 15% of the money now invested in Japan? Why Japan?
Why? Simply, Pimm, because that market has been in a bear market for 20 years, and as a result, it's by far the cheapest market in the world. Barely trades above 1 times book value, and I would submit to you that it's a very hard book value, not much in the way of goodwill intangibles. And also, over the past 20 years, companies have had a chance to fix their balance sheets. In fact, balance sheets now are way too strong. They have obscene amounts of cash. And my belief, I'm obviously delusional, is that some of the companies will start giving that money back to shareholders in the form of higher dividends and stock buybacks.
Well, indeed, there has been some effort on the part of Japanese companies to initiate stock buybacks. KDDI, for example, right?
Yes. Now, KDDI is not a vastly cash-rich company, yet it's a telephone company that generates a lot of free cash flow. And we were thrilled 2 or 3 weeks ago now to see them come up with a buyback. They intend to buy back 5.2% of their shares outstanding. And in fact, the stock has gone up 15 or 20% on that news. And despite the run-up, we still think that KDDI offers great value.
All right. Now, what about another company? I know you and I have spoken about it previously. This is Fanuc. They are the makers of these robotic systems that they are now really exporting not just to the United States, but heavily to China.
Yes. Now, Fanuc is not as cheap as it was, so I would not chase it, but we still own some. Now, Fanuc derives 30 to 35% of their sales now in China. as the industrialization of China continues. And so a stock such as Fanuc, and there are many others like that in Japan, basically offer an indirect and partial entry into China at much lower multiples than you would if you were to buy a Chinese stock outright. And you can complain about Japanese corporate governance not being the best, but then again, maybe it remains better than the corporate governance of an average Chinese company.
All right, so let's talk about inflation, because you've also mentioned that in addition to searching for value, you want to search out stocks that are going to be a little bit resistant or at least able to take advantage of inflation. You don't want them to get hurt by inflation. Companies you've been looking at, MasterCard, Marsh McLennan. Why do you think inflation is somewhere in the future?
Pimm, yes, why would a credit bubble that bursts, which is something deflationary, why would that result in inflation is a good question. And I think it's the answers because policymakers, especially in America, have been obsessed with the specter of the Depression. We don't want that to be repeated. And so we have policymakers, not only here, not only Bernanke with his QE2, but even Europe with the bailout. And possibly in China to the extent that they don't want to let the Chinese currency get appreciated. Basically, we have policymakers around the world that whatever they're doing is very likely to cause inflation down the road.
So now, creating a lot of money.
Yes, printing money. Now, inflation may only be noticed in the CPI only in 2, 3, 4 years down the road, but I'm pretty sure that it's coming. And in any case, even if the odds of that happening remain low, you have to consider the consequences. And as an investor, the ultimate challenge is always how do you defeat inflation. That's how they get you. And indeed, we have tried to find around the world many companies such as Wal-Mart, Marsh McLennan, Publicis, advertising company, MasterCard. Those, if you think about it, are not capital-intensive business models. They typically have an ability to raise their prices along with inflation. Or in the case of MasterCard, they will get the same basis points, percentage on higher gross transactions with inflation. And most of the cash flow is free cash flow. Very little of it has to be reinvested back in the business at higher prices. And so basically you have streams of free cash flows to come that can grow by as much as the inflation rate. And because the price of TIPS, Treasury inflated protected securities, inflation have gone up so much, we think that many of these stocks offer a better alternative, a cheaper way to try to beat inflation in the long run.
All right, so we got Marsh McLennan, MasterCard, Wal-Mart. I know you mentioned Sodexo in the previous segment.
Yes, Sodexo is a food catering company.
Right, global in nature.
Yes.
And also KDDI as well as Fanuc, but don't chase it. But I have to always ask you about gold. What about the position of gold right now, about $1,400 an ounce?
Well, we still like gold. I think gold is something you should own if you have something to lose. Gold is something you should have if you don't totally trust the governments and their central bankers.
And how much should you have in terms of gold? What's the allocation?
But the reality, Pimm, is that over the recent past, gold has gone up over the past 3 or 4 months. Until a week or two ago, gold was up sharply along with stocks. Likewise, in 2009, gold was up in sympathy with stocks. And this makes us nervous. The more gold is positively correlated to equities, the higher the risk that when equities correct, gold may go down with it. In fact, until a few days ago, gold had corrected along with the equity market. So we have reduced our position slightly to around 4.75%, 5%. That may strike you as a small allocation, but then again, gold is something that can go up 5-fold. In fact, in the 70s, gold went up 20-fold. So even a modest 5% allocation to gold could do wonders if things get worse.
Always hedging your bets. I want to thank you very much. Charles DeVoe coming to us from IVA, International Value Advisors. Appreciate your insight.